Welcome back. You're watching The Money Show. Now, there are plethora of funds available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have on board Harshvardhan Roongta, CFP, Roongta Securities. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Good evening, Harsh, and welcome to the show. We are now joined by our viewer Tarun, who wants to ask you his question. Good evening, Tarun. Thank you so much for sending us your query. Tell me.
Good evening, Roongta ji.
Hi.
I have already put my portfolio to you.
Sure. Yeah.
So I have three basic queries.
Yeah.
I would be requiring 25 crores after 20 years. So looking at my portfolio, what all adjustments are required to be made? And secondly, I'm a central government employee.
Sure.
My net salary is around 20 lakhs. So is it prudent to still keep on investing in PF, the Employee Provident Fund?
All right.
And thirdly, I have my parents, my father retired, senior citizen. So I already invested around 13 lakh rupees in senior citizen savings scheme. He is getting some additional corpus from some property of around 16 lakh rupees. Where shall I invest this money? I would be, my basic underlining is that I would want some monthly income from that corpus.
Okay. All right, got it. I like the clarity that you have in your questions and the kind of portfolio details also you've sent. I can see Harsh also smiling on that. Harsh, I'm sure you agree to it, but then let's talk about his fund mix first. Okay, where do you think he needs to change?
Okay, so yes, Kavita, you rightly pointed out that Tarun has got all his nitty-gritties well in place. So the first, if you're asking about commenting on the portfolio that he has, I guess the schemes are good. There is a little bit of overlapping, but that's negligible. So I would say that he can continue investing into the existing schemes. The allocations are also fine. So the spread and the diversification across different market segments is good. So I don't think there is any change that I would recommend on his portfolio that he has currently. More so speaking about
can there be an addition of a new fund, or that is something he need to really stay out of?
No, so Kavita, as I said, there are 7 schemes right now, and he has a plan to top up in 2 of his schemes as well. The diversification is good enough where you don't need any more schemes to come in. So Tarun, as and when your income goes up or you want to increase your SIPs, do not add any more schemes. Just top up in the same schemes that you already have. So that part of portfolio construction is perfect. There's no need to make any changes there. Now, if I come to the corpus that you intend to accumulate
Harsh,
after 20 years.
What about the investment amount? 5 crores in 20 years, is the investment amount enough, or he needs to increase the amount of his SIP?
No, so if I look at all his investments, current fund value being at about 8 lakhs, the SIP of 25,500 going right now, there is going to be a top up that he's going to do in 2 of his schemes. Plus, there is a 5,000 rupees SIP that is being done in direct equity. So I think if I put all of this together, he should be very comfortably able to achieve the target of 5 crores in 20 years. So I don't think there is any problem on that part.
That is sorted. Now let's answer his EPF question. Okay, so Tarun, I also want to know, are you taking any home loan benefits?
Negative. I don't have any home loan.
Okay.
Neither have any health insurance. It is being provided by my company.
All right. So Harsh, what do you recommend to him? Should he be shifting to a new tax regime?
No, so the question specific is that being a government employee, does it make sense for him to contribute into the EPF? Very simply put, whether you are a government employee, whether you're going into a new tax regime or you're filing tax under the existing regime, the EPF deduction is still going to happen out of your salary. So there is no choice with you saying that I'm going in for the new tax regime where there are no tax exemptions. So please do not cut my EPF. So I think that the deduction and contribution to EPF is going to happen. And besides, Tarun, if I look at it as EPF as an independent investment option, it's an excellent debt allocation. You have a tax-free income that you earn out of it. The interest that you earn on it, 8.1% is tax-free. It's an excellent debt allocation that you would need to have in your portfolio in any case.
All right. The third query is of his father's retirement. 16 lakhs he wants to invest approximately, and he also wants to generate regular income through SWP. So, what should that strategy be? He's already invested 13 lakhs in post office citizen savings account.
Yeah. So on that count, the investment that you've done in the senior citizen savings scheme is a good option. I mean, of course, there is no doubt on that part. You can most certainly plan a regular flow out of an SWP. You invest that money into a scheme, and from there, when you do an SWP, you will get the money. Your father will get the money on a regular basis in his for his monthly expenses. However, I want you to just be a little careful about the scheme that you invest into. The 16 lakhs that you will be parking money, if it goes into a hybrid fund, whether it's conservative, it's aggressive, it's a dynamic asset allocation fund, which kind of fund are you investing into? That needs to, there needs to be some mind put onto that, because eventually the 16 lakhs will go there, and from there is going to be a systematic withdrawal happening. So the
Now
money
the question that
lying
came
in
in my
that scheme.
mind, Harsh, was how much out of the 16 lakh will be the monthly requirement? Based on those calculations, we can choose the investment instrument. I think we will need Tarun's help over here to help us understand. Tarun,
Yes.
how much of monthly income would your father need from this investment?
From around 10 to 15,000 rupees per month.
10 to 15,000. Harsh.
Yes.
Okay, yeah. So then, I think, and if he does not require this money in the next 5 to 7 years at least, then he could put into an aggressive hybrid fund or a dynamic asset allocation fund. The 16 lakhs can be
Tarun?
parked into dynamic asset
Tarun, is
allocation
that
fund.
the case? Your father doesn't need that money for 5 to 7 years, or it's an immediate requirement?
No immediate requirement as such, but I would want some monthly income, monthly flow.
But
of
after how
income.
many years? Say we invested today, okay? And after how many years the monthly income would be needed?
Year or two.
Year or two, Harsh.
Yeah.
Yeah. So the lump sum gets invested into a dynamic asset allocation fund or a hybrid fund.
Okay.
And the SWP then can start whenever his father requires it. So if he requires it from the next month itself, you can set up an SWP, or you can do it after a year, let some accumulation happen, and then you can start withdrawing out of it. So that is one option. So why I emphasized upon whether 16 lakhs should go into will largely depend on how much time he can stay invested. So if he can stay invested and not require the 16 lakhs to be withdrawn in the next 5 or 7 years, then probably a hybrid fund would be a good option. Additionally, Tarun, I would also suggest that you could look at parking some more money into senior citizen savings scheme starting 1st April, because the limit has been revised to now 30 lakhs per individual. In case you're comfortable and your father is comfortable with that, then that is also an option that you can explore, and you get about 8% interest payable quarterly on that. So there would be some cash flow coming in the form of additional senior citizen savings scheme. But honestly, if you ask me for my opinion would be that you look at a hybrid fund with an SWP as an option, very tax efficient, and it will help you beat inflation over 5-7 years that you want to stay invested as well.
Important to also keep a focus on growing the amount of money that you're investing. I mean, you have the facility of an SWP, it's fine, but then it's important to even grow the invested amount. Is there anything else, Tarun, you want to ask Harsh?
No, thank you so much for your assistance.
All the best, all the best. We move on. Satya's question, and Satya says that he has an investment in ABSL Balance 95, ABSL Tax Savings 96 fund, and both of these funds are underperforming. So he wants to understand if he should stay put or exit, and if at all he should be switching. So what should be the category, and the time horizon over here is 5 years.
Yeah. So Kavita, the mention is the requirement is 5+ years. So I don't know,
Plus
5
years,
plus
right,
means
right. Yeah.
I don't know how many more years above 5 years. Nevertheless, let's just
5
a
years.
little.
We'll take the benchmark as 5 years, and then let's give him a plan accordingly.
Okay. So yes, it's true that the schemes that he's invested in currently are underperforming, and there is a case to make a switch into another scheme, considering that he has a time horizon of 5 years and he has existingly been invested into a predominantly an equity scheme. So his balanced equity hybrid fund that he has is an aggressive hybrid, and the tax saving fund is also an equity scheme. So I think he could move very conveniently into an aggressive hybrid fund itself in the same category, and the schemes he can just change. So I'll give him two options. He can choose either one, and depending on the amount that he has, he could probably even split this into two, depending on the exact amount. So ICICI through equity and debt fund is one such option, and the other is Canara Robeco equity hybrid fund. He can choose either one or two and split the money accordingly.
All right. We move on to our next query, which is from Colonel Manish, and he says that he's an army officer and he'll be retiring in a few months. On retirement, he will receive 1 crore approximately, and he wants you to strategize his investment accordingly.
Kavita, so, if you understand the query, just simply says that I have 1 crore going to come in the next couple of months. Please advise something which is safe in investing. I think, you should never plan your retirement with just one simple parameter. Retirement is a life-changing event, and all your entire life savings is going to come to you in the form of a corpus, and that lump sum needs to be parked in a very, very judicial manner because you have no further scope of making any errors on this fund. You have no fresh productive income going to come in. So you have to be very careful on how you plan this. It cannot just be looked in isolation to say, give me something safe. Now, what is safe? And that is also going to be important to define because you have to beat inflation. Because when you talk about safe, you would essentially be talking about FDs kind of products, but which will not possibly help you beat inflation after say 5-7 years. You start feeling the pain on your return. And considering he's an army background, he will have a pension that is going to come to him for sure. The accumulations through DSOP, AGIF that he has got till now, looking at the fact that he has pension coming in, which is secured and is going to be lifelong, there is a window open to consider that he could invest this into, say, probably conservative hybrid funds or aggressive hybrid funds to ensure that he beats inflation continuously over a longer period of time, even post-retirement. So I think rather than giving him a plan, I could simply suggest the methodology. He should approach a financial planner, sit down, understand what are the requirements. If you have a requirement which is near term, which could be, for your children's education or marriage, that is a possibility. I have seen lots of such cases where post-retirement, the army officers have to take care of the expenses of the children's education and marriage. So there is no point in looking at investing for long term. So the exact nuances need to be known and then a plan needs to be made. Most certainly, I can say for one thing for sure that you need to split this amount into and put one part into a fixed deposit kind of a scheme, wherein a senior citizen savings scheme works best. You can put up to 30 lakhs now, starting 1st April 23. You can each individually put up to 30 lakhs of rupees and earn 8%, which is paid out quarterly and backed by Government of India, so there's no risk on that part. So I think that one portion I can give a sure suggestion. However, the other part will depend on his, of course, understanding of the market volatility, beating inflation, the objective, cash flows, requirements that he has for his children, if at all, if any. And then probably a product basket can be made for the balance 70 lakh rupees.
Right. I think on that note, it's a wrap for this segment. Harsh, thank you so much for being on the show and helping our viewers with their financial portfolios. We will slip into a short break and then post that, let's talk about growing story of women entrepreneurs in India.